Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I have a really exciting episode today. It's something I've been thinking about for a while, and actually after doing the analysis and then writing the blog about it, actually something I'm a bit embarrassed about because it's taking me more than 20 years to work this one out. But then again, I guess the thing that makes me feel a little bit better about it is that I haven't seen this strategy talked about anywhere else. So a bit surprised, but anyway. So the strategy I'm going to talk about is, a way that you could potentially still enjoy the same negative gearing benefits, but reduce the amount of capital gains tax you pay by over 30%. And I think that's probably an attractive proposition to every property investor out there. So the strategy is to use a company to invest in property. So that is the company buys and owns the property that you invest in. Now, most people don't use a company, a proprietary limited, private investment company to hold investment properties. And if you go and speak to an accountant, most accountants are going to tell you there's a couple of reasons why you wouldn't do that. The first one is that there's no immediate negative gearing benefit. So because a company can't distribute a loss, it needs to have retained earnings or current year earnings in order to declare a dividend, so then pay money out to shareholders. We know that if we're going to borrow to invest in property, that will likely have negative cash flow. So it will record a taxable loss because, of course, the rental income is less than the expenses, including interest. And so whilst you will actually get the benefit of the negative gearing in due course because you can carry forward losses in a company, those losses are quarantined in the company. And so you can't, as a individual, whether you are in business and you pay yourself a salary or get a distribution, or whether you're an employee, you can't offset that loss against your other income as an individual. And that's a key benefit, right? We've talked about the internal rate of return, minimizing the amount of cash you need to put in a property. One of the key elements of that is maximizing your tax benefits, because that'll minimize the after-tax holding costs of a particular asset. So a company is no good for that. The second attribute that most accountants will talk about is the fact that you can't get access to the 50% capital gains tax discount. So we all know that if we own an asset in a trust or in our individual names and we've held that asset for more than 12 months, that if we sell that asset and make a capital gain, we're typically able to discount that gain by 50%. And then 50% of that net gain is then included in your taxable income in that year and taxed at average marginal tax rates. Of course, if your taxable income's over 190,000, you'll pay 47% tax on that gain. But because you'll be able to discount that gain by 50%, what you're really ultimately doing is inevitably paying 23.5% really tax on the full capital gain, which is not a bad outcome. But in a company doesn't get the 50% CGT discount. So it'll pay a flat tax rate of up to 30%. Could be 25% if it's a small business entity, but let's just say 30%. So really you're comparing CGT in personal name 23.5% versus company 30%. There's a 6.5% differential there. You're paying more capital gains tax. Hang on, Stuart, you said the episode was about saving capital gains tax. I'm going to get there, of course. So these are valid reasons of why you shouldn't, or why people would say don't invest in a company. But let me talk about a way of structuring it and then a way of structuring the distribution of an eventual capital gain to hopefully both maximize negative gearing benefits and also reduce the amount of capital gains tax you pay, probably by over 30% or something pretty significant anyway. Okay, so how are we going to structure the property initially to be able to get that negative gearing benefit? Well, as I said, if the company records a taxable loss, it's trapped inside the company, carried forward to offset future potential profits, and then can be paid out as a dividend. So it's trapped inside there. We want to get the interest deduction essentially outside of the company, because we know the expenses are going to be less than the rental. So there will be some net rental income. The biggest expense is interest, of course, and that's the one we want to get outside into our personal name. The way that we can do that is by establishing a new company and asking that company or making that company issue shares to us, much in the same way that a company will list on the Australian Stock Exchange. They will issue new shares and they will do a fundraising, they'll raise capital, people will pay money for those shares, subscribe to those shares, and off you go, the company is listed on the ASX. So in much the same way, we can go off and establish a new company, and I'll get to the costs and so forth of doing that later in the episode. But let's just use a really simple example. Establish a brand new company, issues you 1 million shares, and you pay $1 for those shares. So that's the face value. You do that by going and borrowing $1 million from the bank to be able to do that. So you go and get a loan for $1 million, and all these transactions will happen concurrently, all at the same time. But let me just walk you through it. You go and borrow $1 million, you give that $1 million into the company. The company then goes and buys an investment property for, let's say, $950,000, so it can pay for all the costs and so forth. And so essentially, you now own 1 million shares in that company that are worth $1 each. You've got the interest deduction in your personal name because you borrowed to buy those shares. The company owns this property. There's no debt inside the company because it used the equity it raised from you by issuing those shares. The company will have rental income. It will have property expenses, maintenance, management, insurance, all the expenses associated with the property, I should say. And therefore, at the end of the year, it will have a profit it can distribute to its shareholders. That is you. So you'll get the net rental income. You've got the interest deduction in your personal name, and you are in exactly the same position as if you purchased the property in your personal name. Now, because you probably need to use the property as security for the $1 million loan, as well as additional equity in other property, you need to be careful about how you structure those two loans. You probably want to separate them, of course. You need to do that transaction simultaneously. So you essentially set up the company. When you go and buy the property, will issue the shares. You would go and get a loan in your personal name. The security is in the company's name, so the company will need to provide a guarantee. I'll get to some of these finer points down the track, but essentially you've got $1 million loan in your own name and a property in a company with no debt. Now, we've got to think about then what happens when the company eventually sells the property. So, of course, the company, when it goes and sells the property, it's going to hopefully make a capital gain. I mean, that's the whole aim of investing in property. It's going to pay initially 30% tax on that capital gain. As I said, no 50% CGT discount, and there's a flat rate of up to 30%. Could be 25, depending on if you're self-employed, you've got a different structure. Let's call it 30%. But the benefit is that money, that retained profit, that capital gain can remain inside the company and then gradually be paid out over time. And of course, you'll get a credit for the tax that's already paid. So whilst you need to pay more tax up front, the idea is if we then pay out that gain over a long period of time, many years, we'll end up getting a refund of some of those, what they call imputation credits or franking credits, which is a credit for the tax that's already been paid in the company. And that's the problem, right? When we own property in personal names, there's nothing we can really do to minimize the capital gains tax because we crystallize this hopefully really large capital gain all in one financial year. Puts us well over the highest marginal tax rate, $190,000. All of a sudden, we're paying 47% on that net discounted capital gain. Whereas in a company, yeah, sure, we're going to pay a little bit more tax up front, but then we can gradually pay out a dividend over time and essentially spread that gain over many years and get a credit and a refund for the tax. And I'll get to the numbers, of course. You should know by now, I've done a lot of numbers around this. So I'll get to that in a second. But we can return the capital because obviously if we go and sell the property, we need to repay the loan. And so how is that going to work? Well, that would work by reducing the face value of the shares. Now, remember, the company issued 1 million shares for $1 each. Well, what we would do is reduce the face value of the shares, so there'd be a return of capital, and we could reduce the face value of those shares to maybe 1 cent each or half a cent each, and essentially pull 99% or 99.9% of that capital, that $1 million, out of the company. And then we obviously use that to repay the loan. And because it's a return of capital, shouldn't be a capital gains tax event associated with that because all you're doing is really pulling that share capital back. Now, I'm going to talk about, how that might work, how this strategy might work for self-employed people. They could still use this same structure, but there could be a different option. Then I'm going to get into the numbers. But before I do that, I just want to touch on a couple of other potential benefits of owning property inside a company. So firstly, you could potentially change the ownership of the property just by selling the shares, not the property. Now, selling the shares won't incur stamp duty, but it will incur capital gains tax. So of course, that's one thing to think about. But if we have a property in our personal name, say tenants in common, and we want to change the ownership structure, it will incur both stamp duty and capital gains tax. So at least you get around the stamp duty one. Now, there are what's called land rich provisions, which generally apply to companies that own more than $1 million of land and they're deemed, transfer of land rich shares. So that could then be caught by the stamp duty options. But again, it's just something that in the back of the mind, it might not be appropriate for lots of people. But owning property in a unitized structure like a company can be advantageous from a changing ownership in the future perspective. The other thing as well is if you have other assets, either other investments or cash, another option could be to put that money in the company and have the loan inside the company as well if you're confident that it's not going to record an income loss. So that is that because the lower gearing rate or because the company has other investment income, it's going to record a profit each year. So if there's actually no negative gearing benefits, then there's no need to raise share capital in the way that I just explained. You would have the debt inside the company. Now, as I said, I want to talk about, well, what if you're self-employed? If you're self-employed, there could be different options available to you, particularly if your business income structure is structured in a way that gives you maximum flexibility. Which means if we had a self-employed person and let's say they've got a business entity, a trust, and then let's say this property investment company, we might be able to distribute business profit into that company. Potentially on the structure, you might then be able to reduce the tax rate to 25%, which is even better, of course, than the flat 30%, and soak up any negative cash flow, any tax losses in the company. Of course, from a negative gearing benefit, you're only getting negative gearing at the 30% rate rather than the 47% rate in your own personal name. So you kind of need to weigh that up. But a company structure could potentially give you, if you're self-employed, a little bit more asset protection because you could have the shares then owned by a family trust, and that'll give you a little bit more flexibility. So there's a couple of other options there for self-employed individuals to own property, borrow to invest in property, I should say, via a company. And you just need to then think about, how do you maximize the negative gearing benefits? And of course, having the property in a company is going to help you reduce the amount of capital gains tax, which is a great segue for me to move into the calculations to sort of put some numbers around this. So remember I said that the company gets a credit, it's called a franking credit, for any tax that it pays. So of course, it'll initially pay up to 30% of the net gain in tax initially when it sells the property, the company sells the property. So you will have to pay more tax up front. But because we get a credit, we can then pay a dividend out each year over many, many years and then get a credit for the tax that we already pay and then potentially get refunds. The best way to explain that is probably use a worked example. So suppose we make a $1.5 million net capital gain. So that's really what we sold the property for, less selling costs, less the cost base. And the cost base is going to be, of course, what we bought the property for, any associated expenses, including buyer's agent fees, stamp duty, those sorts of things, any capital improvements, net of depreciation that we've made. That's really your cost base. So that's to calculate your net capital gain. And then you'll pay 30% tax. So let's say we made $1.5 million net capital gain. 30% of $1.5 million is $450,000. That's what we're going to pay initially, and we'll have $1,050,000 left over in the company after paying that tax. Now, of course, we could pay that out as a dividend all in 1 year, but as I said, what I'm suggesting is that we pay the dividend out over time. So I modeled paying that out over the next 16 years. So we get rid of that $1.5 million capital gain and spread it over a 16-year period. Assuming we had two spouses to pay it to, I should say, as shareholders, we could pay each spouse a dividend of $31,500, and attached to that would be franking credits of 13,500 because we've already paid the 30% tax, which would give each spouse a taxable income of 45,000. Now we know people can earn up to 45,000 and only pay 18% tax. We've already paid 30% tax. So in fact, what will happen is we'll get a cash dividend of 31,500 plus then a tax refund of $8,500 because we've got that franking credit to offset against our personal taxable income. And as I said, it'll take us about 16 years to get all that retained profit out of the company and benefit from those franking credits. And I worked out that essentially as a result, the total tax we'll pay on that $1.5 million is $164,000. So in percentage terms, that's really low. Well, it's just under 11% of tax. That's a lot lower, right? But of course, we've got to take into account the time value of money because we've had to pay the 30% tax up front, and then we'll pay dividends out over 16 years. And so, we've had to wait many years to eventually get those tax refunds. So if you build in the time cost of money, essentially the tax that you pay is about $213 or 14%. So still a saving of about $82,000, which is a 28% saving compared to owning the property in your personal name. So if two people owned it in their personal names and they had to go and pay capital gains tax, because we've got a marginal tax rate system, you're not paying the full 47% on the total gain. You end up paying around about 20-ish% in tax. So that sort of gives you an idea of how that saving arises. In theory, you could spread that gain over a longer period of time and really to pay nil tax, to try and keep everyone's taxable income below $20,000, because obviously below $20,000, there's nil tax. It'll take you 37 years to get that dividend out. Of course, we've got to think about the time value of money. I don't want to be waiting 37 years for my full tax refund. So whilst we've paid nil tax, mathematically, if you, again, take into account the time value of money, the real tax rate's about 10%. So that's best case scenario, 10%. In the more realistic scenario, you've got 14%. Either way, it's still better than paying 23.5%, which is, what you're going to pay if it's in your personal name and you get the 50% CGT discount. The other benefit of investing in an entity such as a company is there's no land tax surcharge. So unlike family trusts, private companies don't attract surcharge rates, which means that companies will pay the same rates of land tax as individuals. Now, Victoria and New South Wales have grouping provisions with respect to land tax. So if you hold property in different companies and they've got common ownership and control, they're going to group that. But some states don't have grouping yet, I should say, so be careful, when structuring these things. But so it's possible in some states to, in fact, put property in different companies, and each of those companies will benefit from the land tax free threshold. But again, just be careful about structuring things around these sorts of matters because they can easily change the rules and all of a sudden you're left with all these companies to manage. Okay, like any strategy, there's downsides. So what are the downsides to investing through a company? Well, the first one is the costs associated. It's not very complex. It's not like a self-managed super fund. To run a company is really pretty simple. You've got to produce, or your accountant has to produce a set of financials and a tax return each year and lodge an annual ASIC return, which is a pretty simple document. They cost about $2,000 to set up, give or take. And, a basic investment company will cost around $2,000 to $2,500 a year to run, including ASIC fees and accounting fees and those sorts of things, just as a sort of general rule. So they're not costless, but they're not, not massive cost, I guess. And I guess if you're thinking about the potential savings that you can enjoy from capital gains tax perspective, it's probably easy to make a case that it's worthwhile. There might be complexity around borrowing. What you're essentially doing is borrowing to buy shares in this company. The property will be in the company's name, so the company will need to provide a guarantee to your personal loan, which is fine from a risk perspective, but you need to get a lender that's going to kind of understand that. Also, if you do borrow in the company name, so if you are self-employed or you've got a lower level of gearing, you've got to realize that company loans not all lenders allow offsets against them. So again, you've got to really think about, which lender you're going to use. A lot of those small lenders just aren't really geared to it. So there's a bit of complexity around it. You do want to use a really great experienced mortgage broker, which I sort of spoke about at the beginning of the year in episode 341. So check that out if you want to understand the 5 attributes a great mortgage broker can hold. And another potential downside is what happens if you go and sell the property. You really do need to use all the money all at once. Because what I'm suggesting is that we make a capital gain, the money stays in the company, you can invest that money, say in the share market, whatever, gradually pay out that dividend and spread that capital gains over a long period of time, 16 years, for example, and that helps you minimize costs. But what happens if you're in a situation where because of change in circumstances, you actually need to sell the property and you need all the cash at once? In that regard, you can have a Div 7A loan and borrow the money from the company. Then you've got to charge interest. It can get a little bit more complex, and potentially you might end up paying more CGT rather than less CGT because of the complexity. So, I don't want to jump at shadows with these or invent risks, but it's always good to be, sort of fully informed of what the potential negative outcomes could be. And of course, that's not an exhaustive list. This is sort of general advice, as everything in this podcast. So there could be other factors in your particular situation that you need to think about where a company might be appropriate or even less appropriate than just general sense. And, just sort of finish off this topic, I think diversification is the key to most things, including ownership structures. So I don't think it's a case of, if you're going to be a property investor, you put all your investments in a company name. Certainly if you plan on selling an asset down the track, you want to think about the ownership structure and the potential capital gains tax as a result of that. But a company ownership structure might be one just to introduce into the mix if your plan is to have a property portfolio that consists of more than one investment property rather than putting all your eggs in one basket. But I think it's worth considering and having a think about the structure and how you can make it work to both try and maximize the negative gearing benefits as well as put yourself in a situation where you can minimize capital gains tax as well. And I think it makes sense because as people transition, I answered a question in yesterday's episode about transitioning from being very property heavy into retirement and then building a perpetual portfolio, which really means divesting of property. So how do you do that in a way that's going to help you minimize capital gains tax, but then still allow you to invest those monies in an astute manner? And a company could certainly allow you to do that. Okay, let's get into some questions. The first question is from C and K, obviously initials. C and K writes, I read one of your books, Rules of Lending Game, and I'm currently in the middle of the other one, Investopoly, and I'm really enjoying the episodes. I'm definitely learning a lot. Thanks, C and K. I hope you enjoy the book. We have our home in Melbourne that we purchased in 2001. It's worth $930,000 with a $300,000 loan. We have savings of $177 in the redraw account. So we're only paying interest on the balance of $123,000. We have 2 investment properties, one in my name, purchased in 2023 in Perth, valued at $700,000 with $400,000 loan. Second investment property is jointly owned with my wife, purchased in 2024, so last year in Brisbane, valued at $835,000 with $640,000 remaining on the loan. We also have a deposit loan of $370,000 that they use to pay the 20% deposits on the 2 investment properties. Also have some stocks, mostly ETFs and crypto, of around $120,000. I think stocks and crypto, $120,000. We are self-employed. I own my own business in a family trust. My wife has her business as a sole trader. Our combined income's around $280,000. Super is sitting around 115 for me, and my wife's about 5,000, which we know is low, and she only just started contributing to it. I'm in my late 40s, my wife's mid-30s. We have 2 kids, 8 and 5. In almost 4 years, we're aiming to move to another suburb for better high schools. A suitable house in considered suburbs will cost around 1.2 to 1.5 million. So that is about 3 to 600,000 more than what their current home is worth. Purchasing a home now and renting out and moving in 4 years' time, so buying the upgrade home now, is not an option because my wife's business is tied to our home. It's a fitness studio, and she has a good client base that would obviously disappear if we moved. In order to progress our investments, the only way forward I can think of, since we're still in accumulation phase, is to buy a third investment property either this or next year. Then in 4 years' time, sell a current home and use most of the proceeds of the deposit to pay for our next home. Does that seem like a reasonable approach? Well, see, in case, look, it possibly does. I guess you've got to think about borrowing capacity and cash flow. So if you need another $600,000 odd to upgrade the home, do you have enough borrowing capacity to also do that and hold a third investment property? And then you've got to consider over the next 4 years the relative growth prospects of your home and the suburb that you want to get into. Will they grow at the same pace? In percentage wise, if they do, that doesn't mean the dollar value growth will be obviously much higher on a high value asset. So you've got to borrow an extra 600,000 based on today's numbers, but that could be 7 or 800,000 by the time you get down the track to 4 years' time. You certainly want to include that as a bit of a buffer, I think. I imagine if you do the numbers on that, that would suggest to you that you might not be able to do, well, if you go and buy that third investment property, you might not have the budget then and the flexibility to upgrade in the way that you hope to. Paying down your home loan, so therefore buying a third investment property would sort of lock you out of that. Doesn't make sense. Maybe not the right approach. Putting the money into the home loan, you've got a relatively small home loan anyway, $123,000 of net debt. So that doesn't really sound like a great prospect, although it's still going to save you 6% after tax. And I answered a question in yesterday's episode where I said that's a risk-free return, and it's a pretty good way to park money. I actually think that's probably your best option, except for, or if you expect in the next 4 years, your income's going to change and therefore your borrowing capacity is going to change. I guess long-winded way of saying, if you can afford, both from a borrowing capacity and cash flow perspective, to do both, buy the third investment property now and upgrade in 4 years' time, yeah, that makes sense, as long as you're buying a good quality asset in both instances. If you feel like that doing both might be a little bit more challenging, or you can't see it today, it really is relying on you increasing your income, then a more conservative approach, given the relatively short time horizon of only 4 years, might be to just park the money in the home loan. Okay, next one is from Mark. Kind of interesting one, and sort of proves the value of good quality advice, unfortunately. Unfortunately for Mark, fortunately for me. Okay, so Mark writes, I have an investment property in Hobart, Tasmania. We bought the property with a mortgage of 105% of the purchase price, so they borrowed the full cost. We then did a 1:2 subdivision and sold off the new block. So I think what that means to me is they subdivided the land and sold the vacant land, probably at the rear of the property or maybe on the side. That means that the original mortgage, some of the purpose of that loan was to buy the property we already hold, and some of the purpose was to buy the property that they have subsequently sold. As a result, their accountant has calculated that only 65% of the interest related to that loan is tax deductible. The other 35% is non-deductible. Because they've sold that property, they no longer own it. And so, of course, they can't get a deduction for it. What Mark did is they used the sale proceeds of selling that part of land off and contributed as a non-concessional contribution into his wife's super. So hence the purpose of those funds are now a non-tax deductible use. They bought the property in a family trust because they thought that was a good option for a subdivision. I'm not really sure about that. But now they can't maximise the deductions because the negative gearing is sort of in the family trust. The family trust has other income, other investment income, so it soaks up that loss, but he would prefer that loss to be in his personal name, obviously, so he can offset it against other income. He estimates that the loss, the tax benefits of that negative gearing are about $10,000 a year, and he plans to work for another 10 years. So he's sort of saying, well, that's going to cost me, the fact that this isn't structured correctly is going to cost me $100,000. He said, it's a nice cottage built in 1865 in a good suburb of Hawthorne. I don't really want to sell, but feel like I should sell it and buy something structured correctly, probably in Melbourne. Would like to hear your thoughts. So let me reframe Mark's question. Does a poor structure that's going to cost you in terms of tax necessitate selling the property and replacing it with an asset that's structured correctly? And it's a good question to think about. Really depends on future expected returns. So, if the property in Hobart is expected to generate great returns, then of course you're kind of better off to hold on to it and just put it down to a learning exercise. I mean, at least you're getting some negative gearing benefits because the trust income is soaking up the other assets, other losses, I should say, but not as good as in your personal name. I acknowledge that. The thing, though, you got to think about is with Perth is between calendar years 2017 and 2021. So that's that 5-year period. The market returned 12.5%. That's just the median house price, right? So it's not just general market. So it's gone through a growth cycle already. So it's been pretty flat over 22, 23, and 24. And it might continue to be flat for another few years. That's sort of a bit of concern. So you might might be flat for another few years, and then you might get another growth cycle. But that's just a general market condition. Of course, there's a whole bunch of properties that will outperform and underperform the general market. So you got to form a view on that. The loan is $280,000. That's a non-tax deductible portion. The first thing I would do is split those loans out. So I'd have the 280 portion and the other remaining portion being 520. So you can distinctly identify the deductible, non-deductible. And I don't know what your surplus cash flow looks like, but maybe you can gradually repay that 280. You've put the money in super and you just gradually repay it. And that might reduce, the non-tax deductible interest cost of doing that. But I'm not sure with a 10-year time horizon, I'm not sure I would go to the trouble of selling. You'd have to then consider a capital gains tax as well, because if they're going to pay a lot of capital gains tax, I'd be less reluctant to sell Hobart and then replace it with an asset just because as a result I've got $280,000 of debt that's non-tax deductible. But look, I don't know about the rest of your financial position, whether you have other non-tax deductible debt as a home loan and so forth. So I don't think I've got the full details here, but I think I'm sitting on the fence with this one, unfortunately. I think I'd be inclined to keep the Hobart property unless you formed a view that you think the returns are going to be poor over the next 10 years, in which case then, yeah, you might be better off sort of just taking your money and putting the money in a market I think will perform pretty well, which is Melbourne over the next 10 years. Anyway, a bit short of time, so I might just leave it there for today. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.